Imagine an invisible landlord, like one that doesn't actually own a single brick, doesn't fix a single leaky faucet, and doesn't hold a single mortgage.
Right, they don't deal with any of the physical headaches.
Exactly. But somehow they collect a toll on 9.5 million American homes every single month.
It's wild when you think about it like that.
It really is. So today we are looking at the plumbing of the modern housing market. We're welcoming you, our resident learner, to another deep dive.
Always glad to be here to dig into this stuff.
And today we're looking into a system that has quietly built this just highly profitable empire behind a phrase that sounds, frankly, incredibly dry.
Oh yeah, very dry.
Right. I mean, property management software.
It definitely flies under the radar. Like people talk about search engines and social media platforms as monopolies, but the infrastructure running the places where we actually live goes largely unnoticed.
Yeah, completely ignored by the mainstream. So our mission today is to unpack the Q1 2026 financial results of AppFolio.
A massive technology platform powering the real estate industry.
Exactly. And we are going straight to the primary sources to see how this machine actually operates.
Yeah, to get into the numbers.
We've got their official April 23rd, 2026 press release, and we are digging deep into their SEC Form 10Q filing.
Which is where the real story is always hiding.
Oh, always. Okay, let's unpack this. To truly understand a business, you first have to look at the revenue engine. How does the cash actually flow in?
Right, the top line numbers.
Yeah, and AppFolio's top-line growth is just fascinating. In the first quarter of 2026, their revenue grew 20% year over year.
Wow.
Hitting $262.2 million just for the quarter.
Which is a remarkable pace for a company operating in an industry like real estate. I mean, it's traditionally very slow to change.
Super slow. But there is a mystery in these numbers that we really need to figure out today.
Okay, what's the mystery?
So their revenue grew by 20%, yet the total number of physical property management units under their umbrella, the actual apartments and houses,
Right.
that only grew by 8% year over year, reaching that 9.5 million mark.
I see what you're saying.
Yeah, how does a company squeeze 20% more money out of a physical footprint that only grew by 8%?
Well, the answer is hidden in their revenue breakdown, and it kind of completely reframes what kind of company AppFolio actually is.
How so?
So when a property management company signs up to use the platform, they pay a core subscription fee for the software.
Makes sense, like a standard SaaS business.
Exactly. And you would think that's their main business. But in Q1 2026, those subscription services only accounted for $58.2 million.
Wait, out of the 262 million total?
Yep.
That is a shockingly small piece of the pie.
Right. The vast majority of their money, a massive $201.3 million, came from what they politely call value-added services.
Value-added services. Okay, looking at the 10Q here, this is essentially a per-transaction fee structure, isn't it?
That's exactly what it is.
We are talking about electronic payments, tenant screening, and risk mitigation, which I guess is basically insurance.
Yeah, insurance products.
Yeah.
And this is how they bridge that gap between the 8% unit growth and the 20% revenue growth.
Okay, break that down for me.
They've built an ecosystem that is just continually increasing the surface area for monetization.
Right.
Think about the physical units as just the territory. The value-added services are the toll booths stationed on every single road inside that territory.
Oh, I like that. It's kind of like buying a smartphone versus using the App Store.
That's a great analogy.
Like the subscription fee gets the property manager in the door, they buy the phone. But the real money is made by taking a tiny toll on the massive digital highway of everyday transactions, the apps.
Exactly. What's fascinating here is that they don't even need to add new buildings to grow their revenue.
Because they're just monetize the existing ones more heavily.
Yes. Let's put the listener in the shoes of a renter for a second. Think about your last apartment hunt.
Oh, painful.
Right. You find a place, you pay a $50 application fee to run a background check. AppFolio processes that, and they take a cut.
Okay.
Then you move in. You don't want to mail a paper check every month because who does that anymore?
Nobody. I don't even know where my checkbook is.
Exactly. So you set up an electronic payment through their portal. Maybe there's a small convenience fee for paying with a card or, an expedited ACH transfer.
And AppFolio collects a toll on that transaction too.
Yep. And then the property manager requires you to have renter's liability insurance. So you just click a button in the app to buy their partnered policy.
Because it's the path of least resistance. You just want it done.
Right, and AppFolio monetizes that too.
So every time the resident breathes, basically.
Pretty much. And that path of least resistance is the absolute core of their strategy.
Because people just want convenience.
As society shifts entirely toward digital-first interactions,
Yeah.
the volume of those microtransactions just grows exponentially.
So the ecosystem is getting stickier.
Very sticky. The property managers and the residents are simply transacting more business online than they were, say, a year ago.
And every single digital touch point is an opportunity for AppFolio to collect a toll.
Exactly.
But wait, why does the property manager allow this? I mean, if I'm running a property management company with, say, 500 units, and I see the software vendor extracting hundreds of thousands of dollars a year in transaction fees from my ecosystem, why wouldn't I just leave and build my own payment portal?
Because of the friction involved in switching.
Switching costs.
Yes, the mechanism that protects this entire digital empire is the concept of switching costs.
How bad is it to switch?
Well, if you're that landlord with 500 units, AppFolio holds your entire operational brain.
Everything.
Your general ledger, your historical tenant communications, your maintenance vendor routing, your tax documents, all of it.
Oh, wow. Yeah, pulling that out would be terrible.
Ripping all of that out just to save a fraction of a percent on payment processing is an absolute operational nightmare.
So the pain of leaving is vastly higher than the pain of the transaction fees.
Exactly. The subscription fee gets them in the door, but the switching costs keep them trapped inside the toll booth ecosystem.
Okay, so they've successfully locked users in, and revenue is absolutely surging. But, you know, a digital empire is only as profitable as its underlying infrastructure allows.
Right, you have to look at the costs.
Yeah, we have to look at the other side of the ledger. What is happening to the cost of running this massive toll collection machine?
Well, this is where the numbers transition from just top-line growth to serious bottom-line efficiency.
Let's hear it.
Their GAAP operating income, that's generally accepted accounting principles, basically the standard baseline, it jumped 50% year over year.
50%.
Up to $51 million.
Just to put that in perspective for you listening, nearly 20% of every single dollar they make is pure operating profit.
It's massive. And if you look at their non-GAAP operating income,
which strips out certain non-cash expenses.
Right, to give a clearer view of core operational health, that grew 35% to $72 million. Wow. That is a 27.3% margin, up from 24.3% in the same quarter last year.
So their profit margins are actually widening.
Oh, significantly. The trajectory is so strong that the company actually raised its full year 2026 outlook.
They did?
Yeah, they bumped expected revenue up to a range between $1.110 billion and $1.125 billion.
$1 billion run rate.
And they project those non-GAAP operating margins will hit between 26 and 28%.
Okay, so here's where I need to push back a little bit.
Go for it.
Because in the official press release, the president and CEO, Shane Trigg, specifically credited this margin expansion to, and I'm going to quote this exactly, putting AI to work across every dimension of our business, accelerating performance for our customers while driving greater efficiency across our own operations.
Yes, the standard narrative we're seeing across the tech sector right now.
Exactly. And frankly, it makes me a little suspicious.
How so?
It feels like every CEO right now is legally required to drop the acronym AI into their press release just to keep Wall Street happy.
To juice the stock price.
Right. Like, how do we know this isn't just corporate window dressing?
It's a fair question.
A 50% jump in operating income is huge. Could that just be traditional corporate belt-tightening? Like, did they just quietly fire a bunch of mid-level managers and label it artificial intelligence?
Look, it is entirely necessary to be skeptical of AI claims in financial filings today. Absolutely. However, if we look deeply at the expense breakdown in the 10Q, the math actually paints a picture that supports operational automation, not just a blunt force layoff.
Okay, show me the proof.
We need to look at a line item called General and Administrative Expenses.
G&A, this is the overhead, right? The cost of running the corporate machine, HR, finance, legal, the administrative staff.
Yes. In Q1 2026, their general and administrative costs stayed remarkably flat.
How flat?
They only went up 4%, landing at $24.3 million.
Hold on. Let me just trace that logic. Are you saying that because revenue grew 20% and transaction volume surged, but the corporate overhead only grew 4%, that proves the AI narrative?
It strongly supports it, yes.
Couldn't that still just be a hiring freeze?
Well, a hiring freeze alone wouldn't sustain a 20% increase in revenue without eventually, breaking the underlying operation.
Why not?
Because when transaction volume scales up that aggressively, you naturally have more vendor payouts to reconcile, more customer support tickets to route, more compliance checks to perform.
Oh, so the actual busy work increases.
Exactly. Historically, to process 20% more business, a software company had to hire 10 or 15% more administrative staff.
But they didn't.
Right. The mechanism of AI in this specific context isn't like a humanoid robot sitting at a desk.
Ah, right.
It's large language models summarizing resident maintenance requests and automatically routing them to the correct plumber.
Oh, wow. Okay.
It's machine learning algorithms automatically reconciling thousands of ledgers without human intervention.
That makes a lot of sense. So by deploying these tools, they basically broke the historical link between revenue growth and headcount growth.
Precisely.
Okay, I buy that. If the technology is doing the heavy lifting of processing those millions of microtransactions, the marginal cost of adding a new apartment building to the platform is practically zero.
And that profit falls straight to the bottom line.
But let me challenge you on the math you mentioned earlier.
Okay.
You gave two different profit numbers. The standard GAAP income was $51 million, but the non-GAAP income was $72 million.
Right.
That is a $21 million gap. What exactly is hiding in that $21 million that they're asking Wall Street to just kind of, ignore?
That is a very critical detail. The vast majority of that gap is a single line item,
Which is?
stock-based compensation.
Ah,
Nearly $18 million in the first quarter alone was paid out not in cash, but in company stock to their employees.
$18 million in 3 months.
Yes.
I mean, that feels like they are printing monopoly money to pay their staff while telling investors to look the other way.
It's a highly controversial accounting practice, for sure, but there is a strategic reason behind it.
Which is?
Building the kind of AI-driven automation we just discussed requires top-tier engineers, data scientists, and product developers.
And they are expensive.
Extremely. You are competing for talent against the biggest tech giants in the world: Google, Meta, Microsoft.
So stock-based compensation is the premium cost of keeping those people in your building.
Exactly. It aligns their financial interests with the company's stock performance.
But it's still a real cost, even if it doesn't drain their immediate cash reserves, which I assume is why it gets backed out of the non-GAAP numbers. It dilutes the ownership of the existing shareholders.
That's entirely true.
They're essentially creating new shares out of thin air to hand to their developers.
Which is exactly why we need to look at how they manage their capital. They know that printing $18 million in stock dilutes the shareholders.
Right.
So what do they do to counteract that?
They deploy their cash war chest.
Exactly.
Okay, let's pivot to that. We've established they have this incredibly sticky toll booth revenue engine. Their margins are expanding because software is handling the volume, and they are keeping their cash inside the business by paying employees in stock.
Right.
So they must be sitting on an absolute mountain of cash.
They really are. If you look at the condensed consolidated statements of cash flows in the 10Q, it shows net cash provided by operating activities was $34.3 million just in Q1.
Wow.
And if you look at their total liquidity, so that's their cash equivalents, and investment securities, they are sitting on $151.7 million.
And the filing also notes they have an entirely untouched $150 million credit facility, right?
Completely untouched.
So the dry powder here is massive.
Massive.
So what does this all mean? How are they deploying this capital to secure their digital empire?
Well, the 10Q reveals a two-pronged strategy. First, they are aggressively neutralizing that stock dilution we just talked about, and then some.
How? Buybacks?
Yes. Under their 2025 stock repurchase program, in just the first 3 months of 2026, they bought back 703,000 shares of their own Class A common stock.
Wait, they spent $125 million on their own stock in a single quarter.
Yep. The filing says they paid an average price of $177.95 per share.
And they still have another $125 million remaining in that repurchase program.
They do.
But I have to ask, usually when a company throws 9 figures at a stock buyback, It's a signal to the market that they are kind of out of innovative ideas.
Right, the old "we don't know what else to do with our money" critique.
Exactly. It says, we don't know what to build next, so we're just going to return cash to shareholders to keep the stock price artificially inflated.
Are they just resting on their laurels here?
If a company was only doing buybacks, that critique would absolutely hold weight.
Okay.
But what we are seeing here is the hallmark of a maturing tech giant executing a barbell strategy.
A barbell strategy, explain that.
They generate so much excess cash from those value-added services that they can actually do both extremes at the same time.
Okay.
On one side of the barbell, they return massive value to their shareholders by reducing the total number of shares on the market, which makes every remaining share represent a slightly larger piece of the profit pie.
Exactly. But on the other side of the barbell, they are simultaneously placing quiet, strategic bets to widen their competitive moat.
Right, because the 10Q clearly outlines that they aren't just buying back stock. They hold $77.6 million in long-term investments.
Yeah.
And the lion's share of that is a massive $75 million position they maintain in a private company called Second Nature.
Now, Second Nature is a perfect example of how they think about ecosystem lock-in.
Because to the casual observer, Second Nature just provides, like, resident benefit packages, right? Like delivering air filters directly to renters' stores,
Right.
which sounds completely unrelated to enterprise software. Why is a massive tech platform dropping $75 million on an air filter delivery service?
Well, to understand that, you have to look at the underlying mechanics of property management. What is one of the biggest capital expenditures and, frankly, operational headaches for a landlord?
I would assume maintenance, like replacing broken appliances, fixing roofs.
Exactly. And specifically, HVAC systems, heating and air conditioning units.
Oh, those are horribly expensive.
When an HVAC system breaks down, it costs thousands of dollars to replace. And it generates all these emergency maintenance tickets that completely stress out the property manager's staff.
Sure, but why do HVAC systems break?
Often. Because residents simply forget to change the air filters and the motors burn out.
Oh, wow. I see where this is going.
Right. By integrating Second Nature into the AppFolio ecosystem, the software automatically manages the delivery of those air filters directly to the residents.
Let me guess. The residents pay for it.
Of course. The residents pay a small fee as part of their benefit package, which is yet another microtransaction.
Right.
But because of that, the filters actually get changed on time. The HVAC systems don't break down.
And the landlord saves thousands of dollars in capital expenditures and deals with fewer emergency maintenance tickets.
Exactly.
So AppFolio isn't just selling software to record a maintenance ticket. They are investing in the infrastructure to prevent the maintenance ticket from ever existing in the first place.
Precisely. And that makes the core AppFolio software vastly more valuable to the landlord.
Because if you leave AppFolio, your HVAC repair costs might literally go up.
It deepens the switching costs immensely. They use their cash war chest to buy stakes in adjacent real estate technology that solves physical problems for their customers.
Keeping them firmly anchored inside the digital toll booth.
Exactly.
And it doesn't look like they are stopping with Second Nature either. One of the most revealing parts of any SEC filing is the subsequent events section at the very end.
Always my favorite section.
It's the part of the document that details what happened after the quarter officially closed on March 31st, but before they actually published the 10Q in late April.
It gives you a sneak peek into the immediate future.
Yeah. And it shows that in April 2026, they dropped another $10 million in cash to buy a minority, non-controlling equity interest in another private company.
They don't disclose the name?
No, they don't, but the pattern is incredibly clear. They're continually using their cash to scout the perimeter, taking positions in any adjacent technology that could either threaten their empire or strengthen their moat.
Taking a step back, I mean, evaluating a business like this requires looking way past the generic label of property management software.
Yeah, that label is almost a disguise at this point.
It really is.
Yeah.
You have to see the mechanics. You have to trace where the money actually comes from. Those invisible high-margin transaction fees generated by millions of renters just living their daily lives.
Paying rent, getting background checks, buying insurance.
Right. And you have to trace where that money goes into stock buybacks to reward investors and targeted acquisitions to ensure absolutely no competitor can unseat them.
Well, let's summarize what we've unpacked today because the picture of this digital empire is incredibly clear now.
It really is.
If you are listening to this, the main takeaway is that AppFolio has completely transcended its origins. They aren't just selling a digital ledger to a landlord. They are actively monetizing the daily lives of 9.5 million rental units.
Yeah, they use a relatively small software subscription fee just to get inside the building.
But the empire is built on the value-added services, taking a cut of the rent payments, the background checks, and the insurance policies.
And they're proving that their technology, specifically their automation and large language models, can handle the sheer volume of those transactions without requiring a massive expansion of corporate overhead.
Which is why the margins are expanding so fast. The technology scales infinitely better than human labor.
Right.
And finally, they are taking the immense cash flow generated by this highly efficient toll booth, and they're using it as a weapon.
A financial weapon.
Exactly. They are buying back their own stock to keep investors happy, while quietly deploying tens of millions of dollars into adjacent companies, like Second Nature.
To make their core software so fundamentally vital to a landlord's operations that leaving the platform becomes financially irrational.
It is a masterclass in building a sticky, highly defensive business model, but it also raises an important question about the evolution of the industry as a whole.
Oh, absolutely. As more and more the physical world gets mapped onto digital platforms, the power consolidates heavily into the hands of the platform providers.
And that's exactly what I want to leave you, our listener, to mull over as you go about your day.
It's a big thought.
Think about that invisible plumbing, the sheer scale of this operation. If a single software platform continues to grow at 20% a year, deeply integrating itself into the physical maintenance, the financial accounting, the tenant screening, and the payments of 9.5 million homes,
Yeah.
at what point does it stop being a traditional real estate tech company? At what point does an invisible digital toll booth effectively become the unregulated central nervous system of the American housing market?
It is a profound and perhaps slightly unsettling shift in how the places we live are actually governed.
It really is definitely something to think about the next time you pay a $2 convenience fee just to pay your rent.
Yeah.
Until next time, keep diving deep.